Hi, I'd like to welcome you to the ICAST 2020 online business seminar series. My name is Mitch King, and I'm going to give you a seminar today on federal excise taxes. I'm going to try to answer some of the more basic questions that you might have as a manufacturer and importer when it comes to preparing your preparing and paying your federal excise taxes. We base what I'm about to present to you on a lot of input and questions that come up throughout the year. So this is what you might refer to as a 2020 update. So here we go. First of all, I wanted to introduce you to a document, an extremely important document that I think has a lot of really good information. And the real neat thing about this document, it's called the Guide to Paying Federal Excise Taxes on Sport Fishing Equipment. It was created by the ASA in 2015, and it's free to you, which is always a good thing. You can get it at this particular link you see on your screen now, or if you don't have time or don't care to write it down, go to the asafishing.org website, look for the Industry Insights tab, click on excise taxes there, and you'll be able to get this document. Let me start out a little bit right up front with some sort of basic information that you probably should already know, but just to make sure, give you an update. The Internal Revenue Code, Section 4161, is sort of where the excise tax gets its start. It basically says that there's going to be a 10% excise tax on fishing equipment, and there are some exceptions, like the rods and poles are, while they're 10%, they do have a cap on them of $10. There's also an exception for outboard motors and tackle boxes, that's 3%. And there's also this last little part here at the bottom where it talks about a 10% excise tax on parts and accessories if they're sold in conjunction with or connection to the sale of a taxable product. More to come on that. One of the big forms that you should be aware of, hopefully you are, is the Form 720. This is the form where you actually might report on a quarterly basis and or pay your excise taxes with this form. The form looks pretty intimidating, but it's fairly simple, especially for fishing equipment. This form is used by the IRS for all excise taxes. So there's really just 4 lines that are important to you as a taxpayer on fishing equipment, and those lines are highlighted here, and the little red dots here on the side of them tell you where they are. So it's not as intimidating as it looks. The one thing I wanted to point out here is the level of detail required by the IRS. It's not much detail required. If you look at these lines, it doesn't ask you how many rods you sold. It doesn't ask you how many lures you sold. It just tells you to give them the excise taxes that are due on that. It's up to you to sort of maintain all the detail that's necessary to support those numbers in case of an audit. But the point I want to make here is that the IRS doesn't have a lot of detail about your company and your business on file. They just know that you paid whatever the amount you might have paid for tackle boxes. They don't know how many tackle boxes that is or how many rods you're making and selling. They just know the excise tax you paid. The other important thing about Form 720 is the filing deadline. If you look at that document, it tells you that the deadline for filing and paying your taxes is the month after the quarter ends, and we're talking about federal quarters. So October, November, December is the first federal quarter, and taxes would be due in the end of January. One important thing I want to mention is just a couple of weeks ago, the IRS, actually the Treasury Department, provided a deferment for the quarter ending the April, May, June quarter of this year. You don't have to pay that at the end of July as you would normally have to pay it. You've got until October 31st because of COVID-related issues. Let me spend just a brief minute on taxable versus non-taxable items. This is always a question that we get and there are 5 pages. There's basically 4 big categories: fishing equipment, fishing rods, electric outboard motors, and fishing tackle. And there's 4 pages worth of detail on what particular items might or might not be taxable. Again, these are available. These pictures here are just 2 pages of that, but the entire 5 pages is available in your ASA's Federal Excise Tax Guide. Another form that often is confusing to folks is what we refer to as the Form 637 registration. This is a form that was developed to help manufacturers and nonprofit organizations or other manufacturers who might be buying product that is taxable, but they're going to be making that product or further manufacturing that product. So Form 637 is a registration that's necessary if you're going to do that. For instance, if you're making a product and you sell it to or you want to give that product to a nonprofit organization for education purposes, whatever, or you want to sell it at a reduced price, if they register as a recipient under Form 637 and you register as a manufacturer under that form, you can then you can both agree that this is a non-taxable sale or donation of a product. Also, if you're a manufacturer and you're measuring that, or you're manufacturing a product and giving it to another manufacturer who is going to further manufacture that product and turn it into to something else. For instance, if you manufacture rod blanks, which are taxable, and you sell those rod blanks to another company who are putting all the pieces together and making a complete rod, then you can, if both of you register with Form 637, you can sell that to that other manufacturer. You can sell your rod blank to him without paying any excise taxes on that sale. Basically, he accepts the responsibility of paying the excise tax on the whole product. He gets the product a little cheaper. You don't have to worry about the excise taxes on that product. And there's some details just for you to look at briefly about the different kinds. For instance, if you're selling or giving your product to a nonprofit organization, you would be asking for a letter F. If you're selling it to another manufacturer for further manufacture, you'd be asking for a letter B determination. This determination is only good once you get the actual letter from the IRS that says you have been approved, and there's some other instructions on how to get this. This last bullet I wanted to emphasize here, it is not. Some people think that you have to have a Form 637 if you're going to be filing excise taxes. That's not the case. You only need the 637 if you're looking to for some sort of waiver of excise taxes because you're giving the product away or it's being sold for further manufacture. You can still do your Form 720 excise taxes, pay taxes, without ever doing a Form 637 registration. However, it's not that big of a deal and might be worth pursuing if you think you're going to be giving product to nonprofits and you don't want to pay the taxes on them, or selling for further manufacture and you want to not pay the taxes. One of the questions we always get is, am I a manufacturer or not? And pretty simple understanding of that. If you are in fact manufacturing a taxable article, which you see the list in the ASA tax guide, then you would be considered a manufacturer. The other person that's responsible for paying taxes, excise taxes, is an importer. Things get a little bit dicier, I guess you would say, with importers and how they get their taxes or how they're identified by the IRS. You have to be an importer that's responsible for paying taxes. The word beneficial owner is key in this, and you need to be a beneficial owner to be a responsible tax-paying entity, not just passing the product through at a port on behalf of someone else. And that's always a point that the IRS auditors look at very closely, and it's worth you paying close attention to. you don't need to, if you're trying to move a product through and it's coming to to an agent of yours, they're not the responsible taxpayer. You will be, because you are the beneficial owner. These bullets here on the page in smaller print are some of the guidelines that the IRS uses to determine if you are the responsible taxpayer and in fact the importer, or if the agent that's actually bringing it in. I want to emphasize this last bullet that's in red because we've heard this quite often from folks. The taxable tax computation sales price is not what you, if you are the importer, it's not what you buy the product for, it's what you sell the product for. This is extremely important because a lot of times I've heard folks talk about paying taxes on how much they actually purchased the product for, and not what they're reselling it. The excise tax is based on the first point of sale inside the U.S., not the first point of purchase inside the U.S. So when does the tax attach? This is another question that comes up if you're talking about accrual versus cash accounting. It's important to understand that the tax doesn't attach when you finally get paid for a product. The tax attaches when the product is actually being moved out of your possession into someone else's possession, the buyer's possession. So keep that in mind. You can't defer the tax until you actually get paid for the product from one quarter to the next. The tax is due when you actually ship the product out. Tax included selling price. This is most of the time folks don't tend to write an invoice and say, here's a $100 product plus 10% for tax, so the total sales price is $110. They basically say, here's a $100 product, and the tax is included in that price, and that's what the IRS referred to as a tax included selling price. And when you're filing your taxes, you need to back that out for your benefit, because they really, on a $100 product you sell, you don't owe $10 in taxes. You only owe $9.09. And this is the math that gets you to that. Take the selling price that you actually included the tax in without mention and multiply it times 1 plus the tax rate, or divide it by 1 plus the tax rate. And that gives you your taxable sales price. And then you add the tax rate to that. So here's the math. Fairly simple process to calculate it, but it's important that you know that really that $100 product that you sold was only a $90.91 product, and you owe $9.09 in taxes and not $10. This is an alternative way of calculating it. Again, it's all math, a fairly simple process, but whichever method you use, doesn't really matter. You still come up to only owe $9.09 in taxes on that particular example. Constructive sales pricing. This is probably one of the biggest and most complicated part of the excise taxes that we see. And I want to try to give you just a little bit of background on where constructive sales pricing came from. For the most part, when excise taxes came into play on fishing, and at least on fishing and hunting products, the business model then was a fairly simple business model. We had an industry that basically had manufacturers who sold to wholesalers, who then sold to retailers, and then the retailers sold it on to the end user. And so what the tax was always computed on what that manufacturer sold it to that wholesaler for. Business models since the beginning have evolved considerably, and now manufacturers and importers are selling directly to large retailers and bypassing wholesalers. And maybe selling it for a little bit more. They're selling even directly to end users, and selling for even more there. But the actual tax that they owe because of these changed business models is what they would have normally sold a product to a wholesaler for. This is where constructive pricing came from. Frankly, it's just a matter of trying trying to keep up with evolving business models and always back calculate to try to find out what the manufacturer would have sold it to a wholesaler for and base the tax computation on that price. So I'll dive into it in a little more detail here. Constructive sales pricing, when you're dealing with this, I've got it highlighted in red because it's extremely important, is you must make sure that you are truly arm's length in your transactions, and this is one of those huge potential traps for businesses, frankly, because arm's length is not defined in any federal regulation to any great detail. There are some guidelines in it, but it's one of those things, because it isn't clearly defined, there's opportunity to drop off the edge of that and get yourself in trouble. So it's extremely important you understand arm's length, and it's not just your particular family of businesses. It is if you've got a special arrangement with someone where you're selling it to them, selling a particular taxable product to them cheaper than you would normally sell to others, that special arrangement puts them within arm's length and not at arm's length. And so keep this in mind. Again, I emphasize it simply because it is a place where you as a taxpayer can get in some trouble. It's a place where the IRS auditors that come to your business and review your books always are sort of looking at very carefully, especially if you have sales to companies that are below what you might normally have sold to. A couple of key definitions that are important is the definition of sale at retail versus sales to a retailer versus sales to a wholesale distributor. The definitions are here on your screen, so I won't dive into them very deep, but there are some very significant distinctions you need to fully understand. All of the constructive pricing, again, as I told you, is designed to try to recreate what a manufacturer may have sold a product to if they were selling to a wholesaler. And there are several examples that I want to sort of touch on here. First is if you have sales at retail and you have no wholesale distributor sales to reach back to and say this is what I would have sold it to. For instance, if you sell a product at retail, so sell it to an end user, and you sell that product for $100, you may have sold that product to a wholesaler for less than that, simply because they're buying more product, that sort of thing. So the ASA went to the IRS many years ago and helped develop a constructive sales price rule that of 60% is what they say in this particular situation. In other words, if you sell that product to an end user for $100, then you're only paying excise taxes on $60 of that sale, 60% of it. This is important for you to understand and for you to know. You don't have to do anything. If you're not selling a product at wholesale, then you get this automatic 60% reduction or 40% reduction, 60% sales price that you actually develop or use to construct the excise tax owed. And keep in mind, we're talking about selling at retail, not selling to retailers. This particular example, this is for selling to retailers, because you might sell it to retailers for a little bit less than what you would have sold it to the end user for. And if you don't have wholesale distributor sales to reach back to, the reduction is you take 90% of the sales price to wholesalers and you pay taxes on that versus the full price that you might have sold it to them for. I give you some just math examples to follow here. In these examples, you notice here there's no wholesale sales to match to, but you sell to a large or small retailer and you sell to an end user with your product, and these are the prices you actually sell to, $75, $90, and $125. I want to make a point here. Don't get hung up on the words large and small. There's no particular size of a wholesaler that makes it a small wholesaler. It's more the price that you charge them. These are just price differentiations rather than size of the company that you might be working with. So in this case, you've got large retailers and small retailers getting these for these prices. And when you start calculating your taxes or the price computation for your taxes, what you need to do is on this one, when you're talking about a retail sale of $125, you can use that 60% reduction, and your tax is going to be on 60% of $125 or $75. The tax is 10%. You owe $750. That's the math there. On these over here, because you're selling to a retailer, you can't use the 60%. You have to use the 90%, and you use it based on the lowest price to the retailer. So if you're selling to a large retailer for $90 and to a small retailer for $90 and a large retailer for $75, then your tax is going to be to the smallest of the retail prices, the lowest of the retail prices. So it would be on $75, and it's 90% of that is what the tax is computed. So $75, 90% of 75 is $67.50. 10% of that is $6.75. So on the particular product you sold, these are the taxes you would be paying on that product. Again, these prices are prices that you assume you did not include the excise tax in the price. So, for instance, if in this particular situation, you would be charging this small retailer $90 plus $6.75 for excise taxes. So $96.75 is what the price should be to them. If you were including the excise taxes on this, you would change the numbers a bit and reduce that number. Sales at retail or to retailers and this is where you do have some independent wholesale distributor sales. It's the lower, as you read here in red, it's the lower of the price for which the article is sold, or the highest price to the wholesale distributors. Again, these are various details are broken out in these IRC codes, and also in several revenue rulings by the IRS that are available in those tax guides for you to follow. But again, if you've got wholesale distributors prices that you can depend on, then you can't use the 60 and 90% reductions, automatic reductions that we talked about earlier. You need to go to those wholesale prices and determine what you would have sold to those wholesale prices based on the information you have. So the lowest of either the lower price for which you actually sold it, or the highest wholesale distributor cost. So I'm going to give you an example of this. And again, these examples do not include FET, so you'd have to change it. If your price included FET, you would need to change that. And here's a spread for you to look at. Again, this gets extremely confusing. I fully understand that, but try to follow me through on this. You've got some wholesalers that are buying a lot of stuff that you're selling a product to them for $115. You've got other wholesalers that aren't buying quite as much. You're selling to them for $125. You get a large retailer like maybe a Walmart or something that you're selling to them for $120. So actually lower than what you might sell it to some of your smaller wholesale distributors. And then you've got the smaller retailers that you don't sell a lot of the product to. You're selling to them for $130. And of course, you're also selling to an end user for $150. Assuming all this, keep in mind your highest manufacturer sales price to a wholesale distributor is $125. The comparison of these two, that's important in your calculations as you move forward. So here's what the excise tax would actually break out to if you were to apply the rules in the previous pages here, and so the excise tax here would be the lowest, either the lower value or the highest value for wholesale distributor price. The actual sales price, if it's lower, But if not, go to the highest value of the wholesale distributor, which is $125. So, of course, this wholesale distributor, you sold it for $115, so the tax will be computed on $115, not $125, and then the tax will be $11.50. This particular smaller wholesale distributors, the tax will be computed on $125. For this larger retailer, because $120 is lower than $125, the tax is on this. For the smaller retailer that you actually sold it to for $130, tax is computed on $125, this figure here. And the same thing here, you sell it for $150 to an end user, but you go to the largest wholesale distributor price, and you use that to calculate your tax. And these are the taxes due in those examples. It'll take you a few minutes to wander through that and wade through it and fully understand it. Again, compare that to the ASA tax guide, and you'll see some more detail. And I want to, again, as I close out the presentation here, I want to again refer you to this tax guide, and I want to emphasize that it's free to you as an ASA member. All you have to do is send them an email, fill out the form that's at this link, and send it to them, and they'll provide you a copy free. Extremely important for you, but even more extremely important for your accountants, because I've talked to a number of accountants, and while they may know state taxes, they may know federal taxes, they may fully understand income tax requirements, it's rare to find an accountant that has a good grasp of the excise taxes on sport fishing equipment. This document will help them wade through that and give them a lot of information that I'm sure they will be appreciative of what you of you giving this to them, and maybe even be able to save you some money based on the information in here. Another question we always get about excise taxes, and hopefully we'll have a seminar that talks about this exclusively, but where do your taxes go? What are they used for? I understand, everybody understands that if you're in a business like yours, you're probably looking at a 3 to 5% profit margin on a product that you're paying a 10% excise tax on. This is this is huge. The excise taxes normally for fishing equipment manufacturers is your second largest expense, second only to your cost of your employees and related to that, and maybe but it is extremely important that you understand that even if this excise tax seems large, it is actually going to support your industry in a roundabout way. The money that goes into this excise that you pay goes into the Sport Fish Restoration and Boating Trust Fund, the U.S. Fish and Wildlife Service. Basically, that money is transferred from the IRS through this fund to the U.S. Fish and Wildlife Service. They, after taking a very small percentage overhead administrative cost percentage, they move the rest of that to state fish and wildlife agencies. The state fish and wildlife agencies use this money to manage the resource, to manage access to the resource, and hopefully more fishing and more opportunities to fish result in more people buying your equipment. And that's what is referred to in my community as the cycle of success. And by paying this excise tax, you can rest assured that it goes nowhere else other than right back to the resource. It's not going to that black federal budget hole. Again, I know you may have a lot of questions. If you probably generated more questions than I've answered here, but you can call, text, or email me at the number and email below, and I will be more than happy to help you. My services, again, as I mentioned earlier, are part of a partnership between the industry and the state fish and wildlife agencies and the Wildlife Management Institute, and so my services come to you free of charge. I welcome any comments and questions you might have.